Well, good morning, everyone. We'll just give you a quick presentation and then take some questions. It's been a good year to be an accountant. The numbers we hope are really set out nice and clearly. I'll just move to page 1. We have KPG in 10 seconds. And what we try to do with this slide is just give you everything you'd need to understand the business. We think it's important in a professional services business that revenue grows in order to provide opportunities for your people. And we're pleased that we've been able to, again this year, grow our revenue strongly, which means strong opportunities for our people. And in a market that the talent is a challenge, we're told, people are ultimately always going to be looking for opportunity in growth organizations. Margin is strong, remains very, very much stronger than the industry. And we're integrating a lot of businesses at the moment, so we will see that margin expand again soon. Parent NPATA is strong, has grown by 23%. Return on equity remains very strong. Gearing is very much under control. Cash flow is very strong, and the cash conversion we're very pleased with. So we've broken the presentation into 4 parts about KPG: financials, outlook, and quality shareholders. I'm joined by our Chief Financial Officer, Kenneth Coe, who'll present on section 2. I'll give you a quick overview about KPG and also comment that we updated our owner's manual with version 2 recently, and this presentation is best read together with that owner's manual. So the track record of the business since its inception in 2006 is that we've managed to double the business now 5 times in a row. We think that's very important because it speaks to the business system that is operating under the business, but has a proven track record of growth. And we like to say that that sort of ideas lead to actions, actions lead to habits, and habits are your destiny. And this business has a good habit of growing and growing profitably. You'll see on the next page that per share growth continues to grow and accelerate. And we very much focus on recurring revenue per share since IPO and owners' earnings per share since IPO, both of which are compounding strongly. We know the market is enormous, and that if we can continue to do that, then that will stand the business in very good stead. Return on invested capital is our next metric, which we like to focus on because we think that it's a good measure of the behavior generally of the business. And you can see that our ROIC plus organic revenue growth is very strong. On the next page, our friend taught us about owner earnings, and here it is. It's the way we think about the business. There's a strongly CAGRing owner earnings, and you can see it growing year to year very strongly. And so for all of you as partner owners, I feel very pleased that we're managing the business in a sustainable long-term manner that will grow owner earnings over time. In terms of capital allocation, we're informed by William Thorndike's amazing book called The Outsiders, which we love, and resonates with our mindset of being sort of outside of people. And we're pleased that we've improved the earning power of our businesses, of our operating businesses. We've further increased their earnings through acquisitions this year, growing our existing accounting subsidiaries, growing our existing complementary businesses, making programmatic acquisitions, and making an occasional large acquisition, which in the last 5 years we haven't done, and we don't expect to do any time soon. And we've repurchased KPG shares over time, and we've held the number of shares on issue. In fact, reduced it since IPO, which is great. So the growth that's being achieved is being achieved on the same number of issued shares. Programmatic acquisitions is our game. It's taken a while for people to understand that what we do. We've done over 50 small acquisitions. We're going to continue to do. There it is, transaction 55. We use our partner owner driver model, and we do that over and over again. And we think that there's huge opportunity just to keep doing that. That number will go up some years and down others. But what this graph seeks to show is that we've been doing it for a long time, and we expect to do it for a lot longer. On the next page, I've just emphasized that 5 years we think is the appropriate period. We've always thought to judge our performance as a management team. This year's results are 5 years since IPO. We're pleased with the progress we've made. We're setting a plan for the next 5 years, and I think you'll be confident that over time we've always out-achieved whatever plans we might have shared publicly. We've done a summary on the next page of the performance of the business since IPO. We're very pleased to now, consider that we've done sort of training wheels first 5 years as a listed company, and we're getting a little bit better at what we do. The group now has 436 team members across 20 offices and 31 operating businesses spanning New South Wales, Victoria, and in terms of global Hong Kong. Our ambitions are to continue to grow wherever we can find people that share our values, which are all about making our people and clients better off. We'll grow as fast as we can find those people, but in a considered way, and we will not drop our standards with respect to how we treat our people, the work we produce for our clients, or how we integrate businesses into our group. On the next page, you'll see that our people have rated us a great place to work. 90% of our people rated us in that way. Our people are owners. They're not just employees. They own a significant chunk of our business, and they're sharing in the performance of the business. And our team member satisfaction measured through our employee NPS score is very high. We are the only listed certified B Corp accounting firm in the world as well, which very much appeals to our people because it reflects their values as to wanting to be part of a cooperative business endeavor with a strong purpose to make our people, our clients, and our communities much, much better off. In terms of services, our services are very focused, and you'll see an increasing focus around accounting, tax, audit, finance, insurance, and wealth and estate office. Very pleased with how the clarity of our services to our clear private business owner client are being refined and delivered in the market. We think this depth and this focus makes an enormous difference. Today, there's 13,500 client groups that have grown by 40% over the last 12 months. And you'll see there's a very strong NPS of 68 with over 700 responses to date. Our revenue growth is very strong. You can see that we are experts at acquiring, and integrating amazing businesses into the group. And I could not be more pleased with the quality of the businesses, the people that lead those businesses, that are in those businesses, that are approaching us to join the group. We'll move as quickly as we can to bring the best people into the business, the right people, and we'll continue to do, as we've always done, that in a very considered way. Our business is a branded offer. We haven't emphasized this as much as I will today, but through 101% signage, fit out, digital, onboarding process, etc., we are getting people to join our community, our tribe of accountants who want a change to the status quo, a better way to do things to make themselves, our people, our clients, and communities better off. This has been consistent since our inception in 2006. It's becoming more obvious as we grow, but there's really compounding effects to the effort that we're putting into the brand against others in the industry. It's growing very, very strongly. That's particularly relevant when you're trying to bring great people into the business. Great people want to join a brand that stands for something, that's consistently presented and consistently behaves and delivers in a way that aligns with their values. And that's certainly the case with our group. Now I'm going to hand over to Kenneth Coe to take you through the financial section.
Thanks, Brad. Hi, everyone. I will go through the financial section now. And the first slide is the highlight slide. So Brett has covered a lot of these metrics in the previous slides, but this slide gives you a quick side-by-side with our prior year results. And we can see that in most of the metrics, we've increased 20 to 30% from the prior year, which is pleasing. Some of the ratios here, I just want to point out, such as ROE, ROIC, cash conversion, etc., they're impacted by the part year acquisitions that we've completed during the year. I'll leave you to go through this slide yourselves in your spare time, as we'll cover a lot of these other metrics in the later slides. In terms of the metrics since IPO, as Brett has gone through in the previous 5-year IPO slide. This gives you a lot more detail. Again, I'll leave you to look at in your spare time, but you can see that we've basically grown the business at a CAGR of in the mid-teens and basically doubled the business over the last 5 years since IPO. In terms of the income statement, our revenue grew at 32.6% to 64.9 million through organic growth of 6.2% and acquired growth of 26.5%. We're pleased that both of these metrics have exceeded our group's target growth of 5% organic and 5% acquired. Our EBITDA margin is slightly lower than what it was last year, and I'll explain that later on in the slide that better explains this. Our underlying NPAT-A attributable to our shareholders grew at 23.2% to 6.3 million, and is a very strong result. Other than this, I just wanted to point out a few items here on the income statement that's grown disproportionately to the revenue growth, which includes depreciation and amortization, which is mainly due to the fit outs that we've done to the offices, the right of use assets that we've acquired as we have more offices open through acquisitions and more office leases, and obviously an increase in amortization expenses due to the increase in tangible assets that we have acquired from the completed acquisitions this year. In terms of revenue growth, again, this shows us the organic and acquired growth since IPO throughout the years. We're pleased that the organic growth averaged 5.1% and is consistent with our 5% target. And we have had strong acquired growth throughout the years, and it continues to be our focus to acquire quality accounting businesses. In terms of the underlying NPAT-A reconciliation, this slide gives a reconciliation of the reported NPAT to the underlying NPAT-A, which is the number that we measure ourselves against on. We have excluded any government grants that we received from COVID, as well as any subsidies that we received during the year. We've also excluded any direct non-recurring costs related to the 8 acquisitions that we've completed during the year. And this includes inheriting various leases that we no longer occupy after we've completed the acquisitions. For example, Sydney, Canberra, Penrith, Narrabeen, these acquisitions we've all inherited leases or we've had overlapping leases. And also we've excluded any one-off costs such as transition and migration costs in relation to the acquisition. This slide summarizes the key measures we see that drives the cash flow and profits of the business. Our lockup days is at our benchmark of 55 days. We're very pleased with this, and given the number of acquisitions we've made throughout the year, and some of these acquisitions has historical lockups of 150 to 200 days. We're very pleased that we've been able to reduce a lot of these very quickly to our benchmark days. Note that here, obviously the lockup we've calculated based on the analyzed revenues, as that makes sense to do so. Our cash conversion is lower than previous years at 83.3%, and it's impacted by the first year accumulation of lockup. Now, I've put 2 slides in the deck that explains this, and we'll go through that as we approach those slides. In terms of the balance sheet, so lockup, as I said, continues to be managed tightly and is at our 55 days benchmark, continues to be very strong, our balance sheet. We've had increases in both our assets and liabilities due to the acquisitions we've completed. So an increase in right of use assets because of the additional leases, increases of intangible assets, and increasing borrowings. Our group and parent ROE, as Brett has covered off, continues to be very high, and it shows the return that we were able to generate with the minimal capital that we require. In terms of the profitability, so this slide explains the EBITDA margins, and this year our EBITDA margin is at 30.9% for our operating businesses. Last year was 33%, and this explains the contributions of the EBITDA margins from the various cohorts. We can see that it's due to a couple of reasons. Obviously, the in-year acquisitions we made during the year, although you can see 30.3% for the first year is pretty amazing for the number of acquisitions we've done, but also due to the small number of growth and subscale businesses, and the definition of those are provided their growth is 1 mil to 2 mil and subscale under 1 million. And these businesses are generating subscale EBITDA margins. The great thing, though, that I want everyone to focus on is our established businesses, which account for 65% of our businesses, continues to operate at 34.2%, which is excellent. And we continue to focus our efforts to scale up the subscale businesses and also improve the profitability of our acquired businesses. And regardless of the above, we continue to operate significantly above the industry average of 19%. In terms of gross margin, this year our gross margin is impacted because of the higher cost of sales from our acquisitions, and we continue to aim for a gross profit margin of more than 60%. But again, we continue to operate significantly above our international peers, and we continue to focus on this because we believe it's a very important metric for long-run performance. In terms of cash flow, we summarize the cash flow here from our operations and the uses of those cash flows. Cash from operations has increased 10%. Free cash to the business has increased at a lower rate, 5.6%. And this is because of the scheduled debt reductions increase because of the increased debt that we've taken on to make the acquisitions. And you'll see there below all the items, all the financing and investing cash flows that we've used during the year. We've drawn $23 million of debt. We've used 12.5% of that for acquisitions, 6.1 million of that for growth capex, which includes buying the Canberra property and various fit outs of the 6 offices we've done during the year, paid dividends, additional debt repayments, etc. So I'll leave that for everyone to go over themselves. On the next slide, these 2 slides are the ones that explains the acquisition impact on the cash conversions. And you can see it here. I think I included this in the first year, in the first half results presentation as well. In the first year, basically, there's an accumulation of debtors and WIP, and that creates basically a reduction in cash conversion. And that doesn't happen anymore in the second year. So in all the first year acquisition, it always creates an impact on the cash conversion percentage. On the second slide here, I do a reconciliation. So basically, if you basically add in that first year accumulation of the lockup from the India acquisitions, our cash conversion is actually at 98%, which is excellent. And you can see there the lockup from the India acquisitions at 72.8% is excellent. As I said before, the historical lockups from a lot of these businesses that we acquire are at 150 to 200 days. And being able to reduce it to that level is really great. And you can see the WIP days is at 17.5 days, which is within our metrics of 20 days. On debt and liquidity, our net debt has increased significantly. But what I want to point out here is even though we borrowed 21.2 million throughout the year for our acquisitions, for our fit outs, etc., we've made principal repayments of 7.5 million. And to us, it's not a concern at all because we're repaying these debts through our cash flows generated from the acquired businesses and generally repaid over a 4 to 5 year period. So we should see this come down very substantially over the 4 to 5 year period. And obviously, we continue to maintain a significant headroom on that. Net debt per partner has obviously increased because of the increased debt, but we don't see this to be an issue. We are repaying the acquisition debt very quickly, and we should see this amount drop down over time. Parent and NCI, I'll leave everyone to look at. We always get asked, why doesn't the NPAT percentage align with our ownership percentage? And it's basically because of tax and the additional investment we make in the parent entity. But I'll leave everyone to look at this in their spare time. In terms of dividends, we continue to pay monthly dividends. We have increased our monthly dividends by 10% since July, July last month. And we have paid one final dividend that we're due to pay on the 5th of August. And we expect the total dividends paid for FY22, including final and special dividends, to be around 7.9 cents per share, and it represents a 57% dividend payout ratio. In terms of cash reconciliation, again, I'll leave this to you to look at. This is a reconciliation of our reported NPAT and the cash from operating activities disclosed in the cash flow statement. You can see the non-cash movements. There's a huge amount there, 3.1 million, and that represents all the balance sheet movements that are non-cash resulting from our acquisitions, right? Mainly employee liabilities that we've carried over, etc. And you can see that actually offsets against that positive movement in trade and other payables and deferred tax assets. In terms of cash flow since IPO, as businesses that focus on cash flow, our cash from operations have increased at a CAGR of 20.5% since IPO, and we've reduced our lockup days considerably. I think we started there in IPO at 94 days, and now it's at 55 days, which is excellent. In terms of first half, second half skews, excluding acquisitions and focusing on accounting businesses, our first half, second half seasonality is consistent with prior years at 53% for the first half and 47 to 48% for the second half. This year, including acquisition, obviously it's skewed towards the second half as we've completed a lot of acquisitions towards the latter half of the year. And in terms of the issued shares, we just want to have this slide to show you that we haven't issued any shares since RPO. And in fact, obviously we've bought back shares, and our shares at the moment are at 45 million, which makes it very easy for everyone to calculate the key measures such as EPS, etc. That's it from me, Brett. Here's the outlook section.
Terrific. Thank you, Kenny. And just before I move to the outlook section, there were a couple of questions that had been typed in. One was, what is your estimate of KPG share price currently? I always like that one. I say that the intrinsic value that we focus on of the business is best calculated using Hagstrom's two-stage dividend discount model that you can find in the back of Warren Buffett Way, and made two assumptions, one around expected future growth and second around appropriate discount value. I've always used since inception the US 30-year Treasury bond rate, because that's what Mr. Buffett himself used. And we are determined not to be involved in businesses that present any risk to us. And we think that with our deep expertise in accounting firms present the lowest level of risk that we can involve ourselves in. Second question was, do you see rising interest rates affecting the company's ability to make further acquisitions? I've answered there no. The first firm that was acquired by the group was acquired with interest rates of 11.1%. I remember paying those rates. So we don't fear interest rate increases having an impact on our ability to make acquisitions. So off to outlook. What do we say about the outlook? Well, the two big learnings that I've shared before the last 12 months is, is meeting Lawrence Cunningham, who's now on our board, and, confirming through his involvement with Constellation Software and subsequent introductions that he's made for me with executives of that business, that we should keep making many small deals in the domain within which we're experts, and that we should look to win in Australia and then look to find ways to take our model to be used by anyone who shares our values and wants to make a difference to their people, clients, and communities. Second one was Will Thorndike and his book, The Outsiders, where he approached us and said, look, he could see that we had this flywheel turning. And so for us, it has been our focus. Everyone who's ever joined the business has been given Good to Great to read, the book by Jim Collins, which talks about 6 steps to, breakthrough performance and building a flywheel. So we, love to, I guess it's always good to meet fellow travelers who get you to continue to focus on the things that make sense. In terms of the 5-year plan that we published 3 years ago, we expect that we are on track in terms of revenue run rate to do 80 million in revenues this year. And so our numbers should look something like that, which is great. I would emphasize that knowing that we've got that 80 million tucked away in our view, we will look to continue to accelerate our growth and to invest in our platform to allow us to achieve, our next set of goals, which is very, very exciting. In terms of the management bench, I've been quietly building out the management bench. We have senior leaders now across people operations, client experience, finance, IT, and digital, as well as legal and risk. I feel very confident that our senior executive team is in place to take this business to at least twice its current size, which is very exciting. In terms of management alignment, we'll do that through an LTI program that'll be based on what Macquarie and Macquarie Bank and Constellation do, where we'll look for doubling of the business, cash-based performance, no options, and maintaining our share count of 45 million or less. There'll be no handing out of share options at Kelly Partners on a confetti basis. In terms of our next 5 years, we're naming a clear set of objectives, and that is to see the accounting group as one of the top 10 largest firms in Australia. And that would mean we'd need revenues in excess of 120 million across a scope of accounting, tax, audit, business advisory, finance, insurance and wealth, what we call complementary services and estate office. And then we believe that we can do that because of our Kelly Partner system, our business model, our partner owner driver model, and our central progress team that are, you know, very unique and I'd say original ways of doing business in our market that are insurgent in their mindset and having a real effect and a compoundingly positive effect. Our second objective is to scale our complementary services by either building, buying or partnering. We've partnered in the insurance space with Ox Brokers. We're considering how to substantially grow finance and wealth. I've set the target to those three businesses that if we are not within 10 years, businesses in those spaces that can do 4 million minimum NPAT, which is last year's NPAT of KPG, then we would not be keen on being in those areas. So we intend to discover what we call a natural conversion rate of finance, insurance and wealth services required by our clients. And that's really important. It's what is natural, what do the clients want, what do they need, what do they ask for? There'll be no cross-selling at Kelly Partners and no sense that the business is about selling things to clients that they haven't asked for. And the final objective is we want to see the business go global. You can see that by bringing Lawrence Cunningham onto our board, by building out a global shareholder base, we are looking and being encouraged to explore how do we take this system that we built and have other people that share our values deploy that system. We think that the obvious markets of New Zealand, the UK, Canada and the US represent an expansion of our total addressable market of nearly 20 times. We very quietly sort of kept these aspirations, you know, internally to date. But I think it's time that we share with you guys as investors that the investment that we're making to build this business has been very substantial, and we just believe that we can grow with our clients into the markets that we see as their future. So we see Australian businesses as staying private longer and looking to export and grow into the US and UK in particular. I'd just love to share these 4 models that we've built. It's our business model at the group level, our business model at our operating level, our partner owner driver structure, and our central progress team. These are 4 very unique ways of thinking that have been developed into ways of doing and have been practiced now for a long time. Ever since we started Kelly Partners, we've never owned a firm 100%. We've always done a 51-49 style structure, so that it is a genuine partnership with genuine owners who are driving that business with us together. Our business is partnerships. We think it's very, very unique in our industry, certainly, and this central progress team that gives us a team of experts working on the important parts of our partner firms just delivers the building of moat, the building of competitive advantage in each of those areas. We're particularly excited about what that means for the business. Now, final section that we've got to quality shareholders. I just direct you to read the Owner's Manual version 2. If you haven't read that, I think you'll find it sharpened up, even more focused. The first version was to answer a lot of the questions that we've been given over time. This is an even more focused document, which we think will help. We want on page 49, you'll see that we've built out a global shareholder base, and our shareholders now are all over the world. We've got an incredible group of shareholders, and you know, I was very pleased recently that we were able to see the last or the back of the last shareholder that sort of ended up in our register by accident, and replaced by really focused quality shareholders. Finally, I'd like to just draw your attention to our expanded board. There's now myself, Stephen Rouvray, Ryan McNamee, and Lawrence Cunningham as independent directors, non-exec directors, and Paul and Ada together with me as people with a deep operating experience in our industry. So I think that you can see that there's a reason for everything that's going on within the group, and I hope that that fills you with confidence as to where we see the future. I'll just answer some of the questions that I can see on the Q&A chat, which is always the most interesting part. So when reviewing potential acquisitions, how do you discern between a firm that is operating suboptimally but can be improved up to KPG standards in the system versus one operating suboptimally that you conclude won't improve enough? It's a very, very good question from Brett Dorendorf. Brett, first, if people don't have the values that things can improve, then, and they don't have the values to actually want to go on the long march, to actually make the difference, to make the effort, to make the investment, it's really about the attitude and energy of the ownership group. You know, are they people that really want to make a change to make things better or not? We do an enormous amount of analysis so that we can see whether the client base itself would be receptive. We look at the reputation of the business in the market, the strength of its brand, etc. There's an enormous amount we do. But fundamentally, leadership is critical in all businesses and in all spheres of life. And so if the leadership group, they actually don't believe things can be better, and they don't believe that by partnering with us, we can substantially improve the business, then that would be the reason that we wouldn't play overwhelmingly. From Trevor Mukadezi, how do you think about the impact of rising interest rates and the growing net debt? Do you expect to keep borrowing at this rate going forward? It's a great question. We don't really fear interest rates, Trevor. As I mentioned in an earlier question, I started a group, I was borrowing at 11.1%. I was always confident that if we're making 35% EBITDA, that interest rates would have little to no impact on the business. So in the short term, we might pay a little bit more interest, but in the long term, we'll be the owner of absolutely tremendous businesses that are enormously advantaged in the markets within which they operate. So it depends. If you're here for a short time, then you might be worried about that. If you're here, as I intend to be, for a very long time over the cycle, I'm not concerned at all about interest rates. We also paid $7.5 million of principal back last year. So the actual level of net debt, if you take level of net debt and take 7.5 plus the increase that we'll pay back in principal this year, we've always aggressively paid down the debt of the businesses we acquire. And in fact, we typically seek to pay down 100% of our share of the debt of that business before we draw dividends that get paid out to the shareholders. And so our approach to debt has always been to, be happy to take it on to buy a great business, but to be even happier to pay it off very, very aggressively. We are paying in those acquisitions, 100% of our cash flows, profits from those businesses, less tax against the debt. Fiona Preston, great results, a nice interview on the Rask podcast. It was great. Thanks, Fiona, to be asked by them to share that information. Just wondering why there is one office in Hong Kong when the business is otherwise largely Sydney-based. It's a great question, Fiona. Ken's been up in Hong Kong for 6 years. I'll share the story. He came to me with tears in his eyes and said, I like working at Kelly Partners, Brett, but my mum wants me back in Hong Kong. He'd been educated here in Sydney. And I said, Ken, call your mum, tell her she can have you tomorrow once you've opened an office for Kelly Partners. The reason I like to share that story is our business has always been talent-led. And so if you've got talented people in your business and they want to open an office, on Mars and you can make it work, then that's been our mindset. But I will give you another comment there, Fiona. I always believe that by locating Ken and his finance team in Hong Kong, we would start to learn how to work remotely and have a much more global view of the opportunity in the business. We've now got 10 people in that office, and it's worked really well, and it's acclimatized our group to being able to work cross-border. To Yanni, inflation, how well are you able to increase prices along cost of inflation? It's a very good question, Yanni. We've always thought that we should grow at minimum 5% a year organically, 3% price increase, 2% volume increase. We can probably get 5% at the moment. Inflation in Australia is running at 6. We've done 6.7% organic growth. So I'm trying to grow organically faster than inflation as a group. And we're pretty confident that we can do that. We're very confident. Now, if we get inflation of 20%, well, let's have another special call about that. But I'm not anticipating that, although I don't view inflation as transitory. Edward Vesely, thanks for the clear explanation of the business. Much appreciated. 2 questions. Are the EBITDA margins achieved for your growth and subscale acquisitions within expectations? And how soon would you expect these to rise towards your margin? At the core, you stated your EBITDA margin target was 37.5. This now appears to have lowered slightly to 35. So the reason for this was the previous target too optimistic. So I'll deal with question 1. Ed, we often buy firms to get into a location, even if they're subscale, knowing that we can add to them. So in each of those instances, one's in the Southern Highlands, for example, in Sydney, where we believe we can continue to grow out that space appreciably, and one's in the Blue Mountains, where we've got a large firm now that's joined us in Penrith, and so the Penrith business is large, and so we sort of look at that business across regions. They may in the future come together, and so we expect that, you know, we're pretty patient, happy to be in a location, do whatever margin makes sense, and grow that business on a portfolio basis that really makes little to no impact. And our EBITDA margin has always been 37.5%. We typically share that it's 35. When you look at our base model for an operating business, it's 37.5. It's not too optimistic at all. If you do, I think we've done 21 million of acquisitions on 64 million, you know, run rate. So if you grow up 30+% via acquisition in a given year, you'll see a little bit of short-term margin compression, but we can see the numbers. We're not challenged by that at all. You'll see that come back to where we would like it, and we're aggressive about it, so it'll happen quickly. Sebastian Campbell, thank you for your question. Great year, KPG. I see that your acquisitions, hang on, somebody move that, that your acquisitions have been increasing since 19. Do you believe the opportunities presenting themselves to you are increasing? Sebastian, yes, the opportunities coming to us are increasing. We're still being as selective as ever, but you can see we've bought 3 groups of, you know, approximately 5 million revenue each in over the last 12 months. Absolutely superb business, and we're very humbled that they have approached us and entrusted us, you know, with their babies, with their business to join us. We expect that our branded offer, the quality of the activities of all of our businesses, and the progress that we're making is likely to be very attractive to firms that really, you know, want to do business at the highest level. Ricardo Gonzalez, as you gain trust of international shareholders, are there plans to add OTC? We interestingly, Ricardo, options so that purchasing shares or reinvesting dividends can be done at a cheaper price. The answer to that is probably yes. I think it's about $20,000. We've been pretty busy. We'll ask the lawyers, because we've been asked by a number of people, could we add OTC options for US shareholders? So we'll get back onto that, and we'll do that for you. What is a repayment profile of debt? Question from Samir. Samir, we've got 8-year debt typically on a practice. We'll pay ours back, our KPG share back within 4 years. We're very aggressive and do that as quickly as possible. To your question about average life of the debt, if you go back and recreate, you know, look at, we're a public company, look at last 5 years accounts and the principal we're repaying, and look at the acquisitions we're making, you'll be able to work that out. Andrew Ing, people can change over time. How does KPG have partners whose values no longer share the same values that KPG does? That's a good question, Andrew. We work strongly to keep our group together, focused on the right values, which are very clearly acting in others' interests, doing what you say, and working as part of a team. We've proven, I think, that we've held the partnerships together for a long time and grown them. If there's a partner who doesn't share those values, you know, as revealed by their behavior, then we typically seek to deploy them to our competitors. Kieran Robinson, thanks for taking my question. Amazing results. Well done to all the team. We've already touched on it, but you've taken on 21 million of debt this year for the acquisitions, and yet while paying it down relatively quickly, would it not be more rational to retain all earnings to fund the acquisitions instead of paying a dividend? Yeah, it's a great question, Kieran. We're often asked, would it be more rational? We don't think that at this point. I wanted to demonstrate as a listed company, and I think I've been proven to be, prescient in this respect. I had the view over the last decade that there are a lot of companies that, spin a lot of hot air, but don't pay out on a partnership basis their profits to their investors. With debt at, sub 4%, it's very difficult to justify not taking on the debt and sharing the repayments or sharing the dividends with our investors. Our partners take dividends every month in cash. Now, our view is that gives the investor the option to simply repurpose those dividends into further KPG shares or do other things with them. In the future, if we can get a structure that I think is appropriate, then we might at one point become like Berkshire Hathaway and not pay dividends. But I want to make very clear to the market and our shareholders who are our partners that we can pay a monthly dividend fully franked in cash, because this is a superb business, I think very, very well managed. Andrew Ing has asked the questions. Our filings indicate that Westpac has been our bank since I started. Is there financing risk with any particular bank? Andrew, all of the big four banks and many, many others have approached me for many, many years asking us to do business with them. We see no challenge with raising debt to fund our acquisitions. But should that challenge occur, then we would, as we've always done, find ways to solve that problem. Angie Commonwealth's great result in difficult times. Do you have a policy regarding directors owning shares in terms of minimum holding or loans? So great question, Angie. No, we don't, but we're pleased that our, if you look up the filings, our directors do hold a lot of shares. And no, we don't have a minimum holding. And no, we don't give anyone a loan to ever buy our shares. We like them to do that. Vincent Ding, I like the gross margin quote. It's very interesting, Vincent, in working out our hedgehog, the financial measure's always been gross profit at the operating business level. And can KPG be a 100 bagger? Well, we've shared the 100 bagger book because we think its principles are excellent. And I think one of the principles of that book, I've been asked this a lot, is that, would it be bad if KPG was a 5 bagger, 10 bagger, 20 bagger, 50 bagger, 75 bagger, or 100 bagger? My focus is for us to build a 100-year, amazingly high quality business that makes a difference to people, our people, our clients, and our communities. And I think if we do that, it's quite likely that the business will do well. And as a shareholder, you'll do pretty well. Final question, Zach Lamb. Do you know if any of your offers service mining, fossil fuel exploration companies? Are there any restrictions in place? That's a good question, Zach. No, I'm not aware that we have. Personally, we don't have any significant exposure to clients in particularly anyway, but I'm not aware that we have any particular exposure to those industries. That said, we haven't sort of gone out of our way. It's not our history to find that type of business. It's not typically where our expertise has been. I hope that helps, those questions. We've got about another 4 minutes if anyone's got any further questions. But I'd like to thank everybody for the faith that they've shown in the company and their support of the business. And I'd encourage you as shareholders, if you can find clients to refer to the firms, please do. If you can find talented accountants that want to join what we think is as good an accounting firm as exists anywhere in the world that services private clients, then please send them our way. I want to thank our teams right across all of our offices, and certainly in our services team, Kenneth Coe, our CFO, Joyce Au, our General Counsel, and our whole senior exec team. It's been another great year. We are pushing ourselves to find ways to innovate I'm excited about the investments we're making for the future. And as always, the first 5 years as a listed company, I think have been a good warm up to what we think is possible. And now we've sort of limbered up and we know what we're doing to a much greater extent than we did when we listed. I think that will be very helpful for the future prospects of the business. So as I always like to say, if there's no other questions, have a great day.